APAC's asset and wealth management industry recently saw India's asset management sector reach new heights, Singapore looked to expand the power of its financial regulator, IPOs in Hong Kong hope for a 2024 bounce back, and a boom in ETFs and equity fund launches in China. Let's take a deeper look at these, as well as other headlines and developments. Starting off in APAC. Morgan Asset Management and Kasikorn Asset Management, the asset management arms of a US and Thai bank respectively, are entering into a strategic partnership. The tie-up will see the US asset manager leverage the local presence, distribution capabilities, and brand of its Thai partner, who in turn will gain access to the market insights, intellectual capital, training, and product solutions of the US firm. Kasikorn AM had a reported 1.49 trillion Thai baht in assets under management as of November 2023, along with 1.46 million clients across mutual funds, private funds, and provident funds business lines. The banking unit is Thailand's second largest lender and attaches great importance to its asset management operations. The two fund managers have a long-standing relationship already, launching Thailand's first liquid alternatives product with a focus on sustainable investing, and joining other global asset and wealth managers like BNP Paribas Wealth Management and Julius Baer in entering into partnerships, and it will be interesting to see how the new arrangement progresses. Despite the examples cited, foreign managers looking to do deals in Thailand are seen as having no idea what they want to do, a situation generated through global managers' lack of familiarity with the local fund industry and not seeing common ground with regards to valuations. Reportedly, Thai industry players are open to discussions on buyouts and partnerships, but these do not eventuate as foreign firms cannot clearly state their objectives in the market and are over-reliant on the local partner. Kasikorn Asset Management notes an instance where it undertook an M&A project in early 2023, where reportedly up to 3 global fund managers were identified, including JP Morgan, but nothing came of the undertaking. A lack of understanding among the global managers considered was cited as a reason the deal was abandoned, and a mismatch in valuations may also have contributed, as these are seen consistently as a factor as to why many potential deals do not eventuate. Some have taken a more collaborative approach to the market, with Franklin Templeton, a global asset manager, cited as a strong example of this when it partnered with Phenomena, a Thai investment management platform and wealth manager, though Phenomena notes that discussions with other foreign fund managers for similar arrangements have not progressed despite being approached all the time, as the parties lack a concrete plan for the market. How long the pairing between JP Morgan and Kasikorn lasts, and how the relationship progresses, will be interesting to see unfold. Moving on. Nikko Asset Management, one of Asia's largest asset managers, has announced plans to increase its assets under management to 60 trillion Japanese yen by 2032, a roughly 2 times increase on current AUM of 32 trillion Japanese yen as of the third quarter 2023, with acquisitions in the ETF and private asset space seen as key drivers of the increase. Nikko completed the acquisition of an asset manager in the United Kingdom, Osmosis Holdings, a quantitative investment manager with AUM of circa $14 billion in September 2023. The fact that non-Japanese comprise nearly 50% of executives at Nikko is seen as an advantage in the negotiations which will undoubtedly be coming along. The initial announcement of the AUM target was made by the Chief Investment Officer in mid-December last year, around the same time that Japanese policymakers made statements towards the effect that Japanese asset managers should pursue offshore acquisitions to lower their reliance on foreign managers and increase their competitiveness. Next up, India's mutual fund industry hit a reported 50.8 trillion rupee, approximately $602 billion in December 2023, with flows into equity funds driving growth and AUM surging just under 2 trillion rupee between November and December that year, following strong stock market performances. Retail investors are drawn to systematic investment plans, which saw 176.1 billion rupees in inflows over December last year, and 170.73 billion rupees in inflows the month prior. Other aspects of India's fund management industry also saw promising signs, with mutual fund folios reaching 164.89 million, SIP accounts reaching 76.36 million, and total SIP AUM reaching 9.95 trillion rupees, all as of end 2023. Over 2023, India's mutual funds grew more than ETFs for the first time since 2013, and SEBI, the regulatory body for securities and commodity markets in India, is reportedly easing capital requirements and disclosure requirements for passive funds. This segment surged sevenfold over July 2019 to September 2023 to reach 7.9 trillion rupee, to account for just under 20% of industry AUM. These milestones and positive developments are increasingly recognized by domestic and international players alike, with various asset and wealth managers entering or re-entering the market or making announcements towards that effect recently. Some issues remain to be addressed, with SEBI alerting AMFI, India's Mutual Fund Manager Association, to the fact that some fund managers had been sponsoring fund distributors on trips as an incentive to increase sales of their products. This was reportedly the second time in 10 months that fund managers had been warned against the practice, which is against both the spirit and letter of regulations. Some had been claiming that the trips were for training programs, something SEBI had addressed in a 2018 circular, where it noted that such programs should not be misused as providing rewards or other non-cash incentives to distributors. With circa 80% of retail and high net worth individual assets managed via the mutual fund distributor channel, the incentive to promote one's own products is high. SEBI is also looking at ways to reduce the reach of finfluencers, financial influencers, who, depending on who you ask, either educate people or promote funds and investments via social media channels. Despite these outstanding matters, with 33 consecutive months of net inflows into mutual funds, the market is seen as shedding the traditional investment areas of property and gold and turning savers into investors, something that should see abundant opportunities presented across the industry. So, that is this episode's section on APAC. To see the full video, check out the links in the first comment below, or take a look at our profile for this episode's other sections. Do let us know your thoughts in the comments below, and if there was a topic or development that you think deserved more attention, point it out to us. Thank you all for watching. We hope to see you next time.